Good morning, everybody. Happy Tuesday. We have an amazing show for everybody today. What do we have, Krystal?
Indeed, we do. Lots to get to this morning. We have the very latest in terms of the SVB bailout, including comments from President Biden and exactly what happened in the markets yesterday. So we'll break all of that down for you. We also have David Dayen on to talk about his analysis of everything that is happening. Incredibly sharp financial observer. So excited to speak with him. We have some news regarding China, both brokering a deal between Saudi Arabia and Iran, but also speaking with Zelensky. And, of course, with Russia and Putin. This is a huge, huge deal. So we'll break all of that down for you. Interesting clip coming out of The View and interesting reporting coming out of the Democratic Party. They are very upset. They want people to shut up about the problems they have with Kamala Harris. They are getting very concerned because you may not know this, but Joe Biden is 80 years old. And they're very concerned that, you know, if people don't love Kamala Harris and they realize that she's number 2 on the ticket and she's a heartbeat away from the presidency, that could be a problem for them. Also have some polling regarding lab leak. Public did not buy the media spin job on that particular issue. So all of that, plus we have Matt Taibbi in the show today, too.
Yeah, Matt Taibbi, so-called journalist. He'll be responding to Congress. And we'll actually talk about the content of the Twitter file, something that you missed, unfortunately, in those hearings. Just a reminder, we're very happy to announce that we have video for all of our premium subscribers on Spotify. So if you go ahead and become a premium subscriber today, you can both toggle between audio and video and actually watch it fully there. People have been absolutely loving it. I know there were some glitches on Spotify's end yesterday, but we got them all resolved, and we should be 100% good to go from here on out. And as always, existing premium subs, I had the instructions yesterday. You just log into your Supercast account, click the Spotify icon, and you can update it. You know, the more I think about it, I think it's a great viewing experience for so many of our audience, because with YouTube, the way that we send our link is we email it to you. This auto updates in your feed. You can just check it.
You don't have
every
to click
single
through
day.
anything. Yeah, it's just
you really
there for
don't.
you.
And so, yeah, for the premium subs, people who've been signing up for that, thank you so much. It really means the world. And you guys get to now take advantage, our large Spotify audience, of the new studio and everything that we're going to be showing everyone. So it's going to look even extra beautiful on that phone screen.
And if you are not a premium subscriber, consider going to breakingpoints.com and you can sign up there and connect your thing to Spotify and you'll be good to go.
We will make it all good to go. Let's start with the Silicon Valley bailout. So President Biden speaking yesterday to try and calm the markets and assure everybody everything is just A-OK despite the bailout. Here's what he had to say.
Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well.
So anytime a politician has to say the banking system is sound and it's safe, you should probably start to ask some questions about what the hell is going on. Unfortunately, Wall Street did not take the president's warning to heed. Let's go and put this up there on the screen. Absolutely stunning day in the Treasury markets. The 2-year Treasury yield posted the biggest 3-day decline since the aftermath of the 1987 stock crash. CNBC writing here, investors swarmed into government bonds on Monday after the collapse of the bank, sending Treasury yields tumbling. The yield was last trading at 4%, down 59 basis points, the largest 3-day crash since October 22nd, 1987, when it fell a comparable 117 basis points, otherwise known as Black Monday. So one of the worst days in stock market history.
But you know, there's an irony here because part of how Silicon Valley Bank got into trouble is they were holding all of these long-term treasuries, and now with this huge market movement, this may have been enough to pump up the value of their long-term treasuries and make them solvent. But anyway, so that will be helpful to other banks that are potentially in similar situations. But yeah, that's what we're looking at.
You can almost not make it up. The major point being, though, that this was a absolute bloodbath of a day for everybody in the regional bank sector. We had the First Republic CEO go on CNBC to tell everyone that, no, it's actually fine. Many depositors aren't leaving, despite the fact that their stock got absolutely massively hammered. Here's what he had to say.
Just spoke with Jim Herbert. He's the CEO of First Republic. And I asked him, what are the outflows today? And he said, it's business as usual. Now, remember, I'm speaking to the CEO. That does not mean Jim Cramer says it's business as usual. That there are not that much, not that many liquidations above 250 million, 250,000. It's pretty much the same as you would expect. The J.P. Morgan funding is working, trying to make it so this situation is stable.
All right, so despite his assurances, Krystal, let's put this up there on the screen. First Republic Bank dropped 60% in its stock value in a single day, leading the decline in bank stocks. Despite the government backstop of SVB, they had to raise its unused liquidity to $70 billion, again, then being able to tap the new Fed facility. And I think that is where we need to focus some of our analysis more of the bailout, right? Because it's important, and we're going to do an entire thing on the Federal Reserve, but to tie these two things together, even with the extraordinary actions of covering, effectively setting the precedent that from here on out, all banks are too big to fail. All banks' deposits are now effectively covered by the FDIC. We're going to see how much more these banks have to pay for the FDIC. And we're also going to see how much more customer fees all of us are going to have to pay in order to make, once again, if you think those banks are the ones absorbing the cost, then you're an idiot. So somebody's going to pay for it. It's almost certainly going to be us, in addition to all of these taxpayer, it may not be actual appropriated funds, but let's just say like having the Federal Reserve backstop all of the treasuries on the balance sheet of every bank in the United States, that's just an extraordinary gift. I mean, basically, imagine if you had a loss on your balance sheet that was declining, and then the government just came in and said, we'll redeem it, though, at the original value of that. That'd be real nice for any of us in the small business world.
Right.
But if you happen to own a gas station or a restaurant, you're screwed. If you're open to own a bank, you're all good now.
If we tried to do that, that would be accounting fraud.
It's called fraud.
Yeah, it would be accounting fraud. And I mean, I think it's important to remind everyone of just what is entailed in this bailout. Effectively, because they are backing up 100% of the deposits, both at SVB and at Signature Bank, de facto, that means every deposit in the entire country, insured or uninsured, is backstopped by the FDIC. And in addition, and this is perhaps the even more significant gift, is they're creating a new lending facility at the Fed so that banks can borrow against collateral, including some of that collateral that has declined in value. They're just going to pretend that it didn't decline in value. So huge change to the banking system without, and this is in a way makes it worse than 2008. In 2008, at least there was some pain extracted from industry in terms of Dodd-Frank financial reform. Now, I think we're learning in real time that Dodd-Frank didn't go far enough, and especially now that we see some of those regulations being rolled back. But there was at least new guardrails put on the banking sector. Here, they're getting a free lunch, and they're not being asked for anything. I mean, I don't hear Biden really, calling for Congress to put anything on his desk. Of course, there are some members, Elizabeth Warren in particular, who are calling for a rollback of that deregulation that happened under the Trump administration. But will that get anywhere when you have a Republican House? I'm skeptical at best that anything will happen on the regulatory front. So they're getting this bailout. They're getting a massive gift from the U.S. federal government, and they're not being asked for anything in exchange. So I think it's really important to remember that. Let me also say, in terms of Biden, there's some new reporting this morning. I don't know if this is really true or not, but the reporting suggests that he really had to have his arm twisted in order to do this bailout because he didn't like the 2008 bailouts, whatever. And at the beginning of the weekend, he really didn't want to go down this path, but effectively, Treasurer Janet Yellen and Powell kind of talked him into going forward with this bailout. So you can see in his comments, he goes to great pains to position this as like a populist play. Oh, we're just backstopping small businesses, et cetera. But ultimately, they're lying about what this really means. They're lying about the extent of it. They're lying about the idea that it's not a bailout. All of this is very, very misleading in terms of what has actually just happened.
So our guest yesterday, Matthew Zeitlin, actually had a great point, and I'll read his tweet here. Quote, "The no taxpayer money just gives you insight into how legalistic and literal that the government now is. The thrust of Dodd-Frank and just the general vibe was that what happened in 2008 should be avoided after the bailouts. So the feds are very carefully just not doing literal 2008 all over again. You can't actually pass a law that says don't do anything wacky with banks again. So the feds will stay within the lines that Congress has drawn. But what Congress has drawn is by giving this extraordinary authority to the FDIC and also with the Federal Reserve and its expanded powers to basically say, oh, well, it's not an appropriated, congressionally passed, taxpayer-funded bailout. Yet the Fed is backstopping the balance sheet of every single bank in the entire United States. And also, we just set an insane and extraordinary standard that all deposits in the U.S. are now covered by the FDIC. Once again, the FDIC has only, what, 100 billion or so in it. There's $9 trillion worth of bank deposits that are not insured currently by FDIC. So who is going to make up the difference, and whose full faith and credit and legitimacy is backing it? The taxpayer. So much of this is just, as you said,
it's semantic.
If we tried to do it, it'd be accounting fraud. When they get to do it, it's because the feds are backing them. And if the feds are backing you, then it's a bailout. I'm reading, I've said yesterday, too big to fail.
Yeah.
And one thing that comes through is many of these deals that happened at the time, JP Morgan or somebody buying Bear Stearns or Barclays buying parts of Lehman, all of this, it was all orchestrated by Hank Paulson and by Timothy Geithner. Now, you can maybe say it's not a bailout because one bank bought another. They never would have done it if the Treasury Secretary wasn't like, hey, you're going to buy this bank, and you're going to do it because I'm telling you to do so. In many explicit cases in the private conversations, the bankers were saying, I would never do this if Hank did not tell me to do it. So that's called a bailout. Okay, like if the Treasury Secretary is basically ordering the senior most people in the financial system to take actions they would not have otherwise done by giving them the legitimacy, the backing of the federal government, well, that is in one sense a taxpayer-funded initiative, because one of the ways that we would do it was by guaranteeing their loans or by giving them the legitimacy, or saying, oh, well, we'll give you, preferential financing on this part of the deal. Of course, that is backed by the government, which by definition is, the representation of the people and of all of the taxpayers. So much of what we're doing here is just semantic games, and it's driving me crazy.
Yeah,
the way they want to wiggle out of this.
Yeah, I agree. And the way that they are gaslighting the public means that they're trying to tamp down any sort of a populist revolt in reaction to this, which, look, politically, I understand why they would want to do that. But because they are trying to tamp down that public pressure, it makes it much less likely that the bank reform that really needs to happen, obviously, after this whole debacle really needs to happen, is less likely to actually come to pass. So that's the unfortunate situation that we're in now. I mean, they have, with these effectively 3 actions that they've taken, they have really transformed how banks are going to see themselves, how banks are going to see, view what type of risky behavior they can engage in. They have sort of revolutionized the banking sector in a really bad way without putting attendant guardrails on the industry. So it is kind of a worst of all worlds situation. Now, in terms of the market moves yesterday, so a lot of regional bank stocks, as you pointed out, Saagar, fell off a cliff. But there's no indication that the big fear that, there was a lot of Silicon Valley carping about and fear-mongering about over the weekend was, there's going to be this huge flight of depositors from the regional banks to the big players. That's why we have to do this. We have to forestall any sort of a bank run. And it's possible that the actions they took worked, and so, they cut off the potential of a bank run. That may be the case. But it is worth noting that even as you had what they described as an investor bank run, so investors fleeing these stocks, you didn't actually see any movement really that we know about, massive movement in terms of depositors pulling their funds and moving them to the big banks. So again, maybe that's because the actions worked, or maybe it's because a bank run was not actually going to happen here, and people in Silicon Valley were just looking out for their own interests.
There ain't no way to know, but what we do know is that an extraordinary line has been passed, and now we're just living in another new bank reality, just like we were in 2009 after the 2008 bailout.
Hey guys, ready or not, 2024 is fully upon us now, and Saagar and I have been brainstorming ways that we can really up our game for this critical election.
Yeah, we rely on our premium subs to expand our coverage, to add staff, to upgrade the studio. We just want to give you the best independent coverage of this election, which is possible. So if you can help us out, become a premium subscriber today, breakingpoints.com, or the link is down here in the description video. It really means the world to us, and if you like what we're all about, this is the best possible way to keep us 100% independent, working only for you.